said it. I don't care who knows it. This is a show that's all about teaching you how money makes money so that you can work less and have more time for the things that matter most. We spend most of our time working to make money in order to eat. Let me say that again. We spend our time working to make money in order to eat. Imagine if money could make us money to eat, removing the working, unless you really love it, and some people do, but then leaving us with a lot of time for family, friends, engaging in a purpose greater than yourself. I'm super excited about this show. We're going to learn how we can invest passively with a working partner. Don't go anywhere. Everyday Investor continues in a moment. Hey, it's Rav. Welcome back to Everyday Investor. Today, we're going to talk about how we can invest passively with a working partner. Make sure you get your pen and paper out. We're going to go through some numbers, and we're going to learn how we can make 20-25% annualized, even more when we're with a working partner when it comes to real estate investing. I'd rather have no one else on the show teaching us about this than Mandy Branham. Mandy, thank you so much for being on the show. Thanks
for having me, Rav. This is awesome. It's always good to see you.
I mean, it's awesome and it's not, because usually when you come on the show, we're in person.
Right.
Get to give a hug, get to say hello in person, you know, all that kind of good stuff. But hey, listen, you know, we're adapting, and let's see if this CNN type show will work or not.
You know what? And it's there's more and more people coming out doing stuff online, but I think it's really important. Like, you got to go to the wisdom, Rav. And when somebody talks about wisdom in real estate, there's no other name that comes to my mind first but yours. So that's why this is the right time, the right location.
Stop it, but I'll take it. Thank you. Listen, Mandy, you live somewhere up north. I know that. You get great prices on acquisitions with great rent. I know that. I'm so inspired because you stay in your lane. You've been doing this concept called joint ventures for a long time. And I wanted to kind of change the name because, listen, my philosophy is if a senior in high school can't understand something, then we're not teaching it right. And so joint venture is just a fancy name for partnership.
Yep.
But talk to us a little bit about this. I mean, you've always been, I'm assuming, the working partner and still are. But talk about this concept of joint ventures, how it works, and how Rav can literally write a check and make north of 20% annualized.
I think about you often, and I think of other investors who are the same as you, who love what they do, or other people, specialists, lawyers, doctors, business owners, teachers. They stay in their lane too. Let them be the best teacher, principal that there is. But they have this inkling that they want to invest in real estate. And then there's this, oh, but I have to learn, and which book do I read first, and where do I go, and do I have the time? And oh, you know, maybe now post-COVID, we're like, you know, they were running off to dance competitions and hockey, and you know, I'm sharing with people that you can invest in real estate, partner with an expert, and not have to learn all that stuff, not have to take the time the time factor that so many people don't have to invest in real estate, whether that be overseeing tenants in toilets and they just go, oh, I don't, like, my head hurts just thinking about it. Or, well, what do you mean I can get a second mortgage? I don't even understand. I need to do research. In comes an expert working partner that says, let me show you what options I have available right now for somebody to be able to come in and partner with. And together we do what we do best. I find and negotiate the asset. I secure the right kind of financing. And over here, the partner says, Mandy, you're the one I want to work with. Let's move on an asset. So it's a way that we both can bring what we both have to the table.
No, I love it. And so in our case, and by the way, I used to do what you did, but then, you know, God puts different things on our heart in terms of what we enjoy. Like we can all tell in the industry, Mandy, you love doing what you do. You love being the working partner. You love acquiring. You love the tenancy. You love the, you know, rehab, if there's any rehab to be done. You love the negotiations. And yours truly no longer loves that. And I have the know-how, but I just don't enjoy it. And I would rather write you a check and then we get to split the profits 50-50. And I think that's where people, they don't understand that the the returns can be so great that there's enough room to be able to split, 50-50 or whatever it is. So what is your model, kind of how does it work? Let's walk us through that. So you live in what area?
I live just near Barrie, Ontario. I invest where returns are best. That's probably something that you will have heard along this industry and certainly on your show. So where I invest has changed over the last few years because I don't try to make a circle property fit in a square box anymore. If it doesn't fit, it's not the right industry. It's not the right market anymore. And I used to invest in my own backyard heavily, and my own backyard has changed. The market prices are catching up and people are moving, and it's not the same lift anymore. So I'm looking at other properties, other cities, where the numbers still work, and I know they still work because I'm looking at all the market fundamentals, things that my partners don't necessarily have to look at. They just have to understand that I've done that. So I do all of the market research. Why St. Catharines? Why Kingston? Why Aurelia? Why have I chosen those properties? If I've brought a property in that city, it means that it meets all of my criteria. A gold mine scorecard from Mr. Don Campbell. He just marks off all the boxes as to why that city is pegged for just a strong rental market. So I always remind myself,
Yeah, you're looking at things like GDP growth. You're looking at immigration, people moving in there. You're looking at, obviously the jobs. You're looking at, and so you're kind of timing out 24 months, 36 months. What's going to happen? So what is a typical, and I know it fluctuates, but in general, what do you like to look at for a return on investment in the first year for your investors?
I don't get out of bed for less than 30%. So minimum is a 15% split return if we're sharing this 50-50.
Per year.
Minimum 15%. Because I know if you go and write that check, Rav, you got a lot of options for 15%. So I need to be able to make sure that that's my minimum. And the rest is, gravy. So appreciation is on top, changes in market rents is on top. People will say, can you show me a deal, like an example deal from 2 years ago? And I say, I can't show you that. They say, why not? I said, because that deal doesn't exist. And when I showed it to them, I didn't have 12% appreciation, and I didn't have that the tenants were leaving and we could turn it over and increase the rents by $400. 3 years happened, and that's why that property looks genius. So it's one of those things that I share with people is they sometimes overanalyze what the deal is in front of them. And they're like, well, I could get 15% here or 16% here or 22% here. And they're getting down to the nitty gritties. And I sometimes say, come back up here and look at the whole picture. What kind of asset are you looking at? What kind of risk tolerance, right? Rav, I've got a great deal, 100% return on investment, but it's in a low-lying neighborhood and it's going to need a full rehab. Like we're talking foundation and all this kind of stuff. And you might go, oh, and we're going to turn it into a rooming house for great cash flow, and it's in Nova Scotia. And you might go, ooh, 100% return or not. There's few too many factors in there that just make me say, no, thank you, that's outside of my zone. Yeah. So even if it's an ROI that people might have, sometimes they just have to be able to say, I'm not in for the worst property on the street. I'm not in for a rooming house. I don't want a student rental. They have certain expectations of what they want. A lot of people are turning to turnkey. They don't want the risk of big renovations, potential big refinance. What if values come down like CMHC is indicating? What if there's an 18% correction and we have a renovation that we need to refinance? Maybe that's not going to be what it is that they want to get into. So it's all of these different factors, but not just the ROI. Look at, can you sleep at night?
Yeah, for sure. Can you sleep at night? Turnkey meaning there's nothing to do. You just turn the key and all of a sudden you have an investment property. We're going to take a break really quickly here, but what is the exit? How long does it take for Rav to get his principal back along with the profits? And generally, what's minimum amount needed to be able to get this with you?
So one more thing about a turnkey asset was really cool. We strategically set up a closing date. So if we close on the 15th of the month, you get some credit for the month that you're in for the remaining. The tenants pay on the first, and you get a rent credit from when the tenants moved in. So technically, before your first mortgage payment, you already have 2.5 months of rent in a reserve fund before you even make your first mortgage payment. How comfortable does that leave you to be able to say, another reason to, people go, oh, I don't want turnkey, but if you get really strategic, you can create a really nice reserve fund before you even get the project up and running.
Love it.
I look at it a 5-year JV. So a 5-year term, in 5 years, we're going to do a refinance typically with the way that the market is. Regardless of what the market is, we're going to do a refinance and get you a big chunk of your money back. And then profits are split only after my partners get their original capital back. So really, some of the profit you might not get in 5 years, but you might get all of your capital, leaving you the profits as equity sitting in the asset.
And generally, I'm responsible for about 20% down of the value, or?
Yes, we create ourselves into a security net. And one of the ways that we can do that, people talk about how do I mitigate risk, 20% down payment, meaning that we've got some space for the asset to fluctuate before we've really touched any of the capital or any of the mortgage that we've got. So 20% down payment. I ask for my partners to qualify for the mortgage, so keeping a good credit standing so that we can refinance in 5 years. And that's what I look for from them.
Great. Listen, love having you here. Can't wait to look at some numbers. We're going to take a quick break. We're talking to Mandy Branham, the joint venture queen of real estate. Don't go anywhere. We'll be right back. Hey, it's Rad. Welcome back to Everyday Investor. We're talking to my friend Mandy. We're learning how we can make a great return on investment simply by writing a check. Mandy, thanks for being on the show.
Thanks for having me.
Yes. So take me through a deal. How long ago was this deal and where was it?
So this is an existing deal. Just share with you that there's a few of them like this. So it's very common. It's a straightforward one. It's a great one. So this is a property. It's a turnkey property in St. Catharines, Ontario, with a sale price of $525 for
$525. So that's what the purchase price was.
Yep.
$525K.
Yep.
All right. Then what happens?
So I need a down payment from an investor of $105,000.
So down payment, and that is what, 20%?
20% of purchase price, correct.
And you said that was what?
105.
105K. Okay, what else am I spending?
Some legal fees, carrying costs, an inspection, an appraisal. We've put in $12,000 for closing costs. That does include in my numbers a reserve fund, ensuring that we have for this asset enough money just to keep the account going.
Okay, so what's it? 12? 12,000. All right, and you said turnkey, so no rehab, no renovations?
No, this is ready to go.
Okay. So that's all I'm in for.
That's all you're in for.
117,000.
117,000.
Okay. So 117K is what I'm in for. So talk to me now.
One little piece on this. I'm going to do a little wink. So the value of this asset is actually $540,000, but because of my negotiation skills and the in that I have with certain investors, we've been able to negotiate a $15,000 built-in value. Okay, lower than market value. So the actual value of this, even though there is no renovations required, is $540,000. So we have increased the value by $15,000.
So right off the bat, you've already made 15K. You've lifted it just by your negotiations.
Yes.
Okay. So 15K I've already made.
Mm-hmm.
And then obviously there's passive appreciation.
Yes, and this one is in St. Catharines. So we conservatively put 4%. So that's $21,000 for the year.
4% of the 525?
I believe it's on the 540 Rav.
Okay, and what did you say the number was?
21,600.
21,600. And
Yes,
then, of course, I know you like your cash flow.
I do. Cash flow on this property, because it's fully turnkey, everything's at market rents, which is really nice, is $8,900 a year.
8,900 per year cash flow. So you're getting just over $700 a month cash flow.
Correct.
This is
Correct.
single. Is this a single family? Is it a duplex? Is it a?
It's a fully legal 2-unit home in St. Catharines, one of the hardest cities to legalize in, which is another benefit to this. There's a lot of people that think they can do this, but if you can find one that's fully done and turnkey, and you don't have to go through that, but you get all the benefits and current market rents, it's a sweet little deal.
But this, Mandy, this here is where, that's where you are able to make a good return on investment, because you're not getting that in Toronto per se. You're not going to get $800-900 with a condo with 20% down. And so this is what you're talking about when you're going into the submarkets, when you're going into the Kingstons, there really is the St. Catharines in this case.
Yeah, and you're looking at things and you're hearing things. Did you know the GO train's coming to St. Catharines? Because there's too many people in Toronto. Yeah, the prices are high in Toronto, but what else is happening in these little tertiary markets? You're watching the 407 get extended. There's new hospitals blooming here, there, and everywhere. Those are the key factors that you're like, hey, this isn't such a bad city, even if it's not Toronto.
Absolutely. So the meat and potatoes, I always say, is somebody paying down my mortgage. I mean, I had my son, he's 19, and he had a bunch of friends over. And, we're always talking money, whether it's stock options, real estate, business. And I said, listen, guys, if I bought a property for $500,000 and 20 years later, I put 20% down, my mortgage is $400,000. 20 years later, it's worth $500,000. I'm so happy. And they're looking at me, what do you mean? You bought for $5 and you sell for $5. I said, I'm so happy because somebody else paid $400,000 worth of mortgage under the mattress. They put it in my pocket, right? Yep. And to me, that's the meat and potato, the debt reduction, paying down the mortgage. So obviously in the beginning, it's less because a lot goes to interest, but over time, we get to pay that significantly. So in the first year, how much are these two tenants paying down my mortgage?
$9,600.
$9,600. I like your style, sister. All right. So if I take the automatic negotiations of lifting 15K, the appreciation 4%, and I'm assuming that's conservative. In St. Catharines, it's more than that.
That's a nice conservative number. Nobody needs to speculate. There's no speculation. You're not losing sleep. It's just a nice solid number.
Okay, so that's 21.6. Cash flow. Cash flow basically is after I've paid all my expenses, the rent that comes in, that's what is left over, and somebody's paying down my mortgage, $9,600 for the year. When I take these four numbers, what do they add up to?
$40,100.
$40,100. So when you want to find out the return on investment, you take your profit, $40,100, you divide it by your investment amount, $117,000. Man, did you have that for me?
47%.
47%. So when I take this divided by that, you're saying I'm getting an ROI of 47%.
Yes.
And so that is not a small number. That is a beautiful number. And you and I get to split this. And so we're making our a return. That's why I say, and you say, yeah, you're happy with 15% or more each. But, in this case, 20, 22, 23, 20, you know what I mean? We're making 23, 24% per year. And that's going to be every year. Sure, I'll take away this 15,000, but my debt reduction increases over time. My cash flow increases over time. So I'm enjoying around a 23, 24% annualized return. Is that what you're telling me?
Yes. That it really is. You know, a lot of people think that they need to do big lifts to be able to get returns like this, and that was my real share for people: is you don't have to overthink this. You don't have to go through the big refinances to be able to have returns like this. But it's knowing what the assets are and the solidity of an asset. So you know, this has room to grow. There's a garage we could rent. There's a fenced backyard. Like, there are things that in a rental property tenants pay for. Now, if we're quickly talking here post-COVID, the other thing about the Toronto market is, people in their 400 square foot little condos anymore paying what? Like $2,000 a month. Rav, they're wanting to move to these tertiary markets. They want grass under their feet. They want to be able to walk down the street and not feel that they've gone through a building and been exposed to lots of stuff. So these rental properties are very advantageous for people who are looking to be able to move out of the city. And it's a very quick way for investors to get into a solid property with instant cash flow. Instant.
So return on investment, 23.4%.
Yes.
Minimum amount needed is 20% plus a few bucks for closing costs.
Yep.
When do I get to enjoy that money? So what happens with this? Are we, like, the cash flow component, right? That's the part that's liquid. Are we putting that back in the property? Am I getting some money up front? Do we work that out? It depends.
It depends. Typically, these properties will, turnkey, we'll say is turnkey. And if anything happens to come up, it's an unknown expense. We treat that like an expense, and we would split any expenses as well 50-50. So let's just say a brand new fridge goes on the fritz and we need $1,000 new one. We would be splitting that 500 and 500. Typically, the cash flow is split evenly between partners. I'm not somebody that pays this out on a monthly basis. Typically, we like to create that nice, solid reserve fund, especially with these unknown times that we're in. I do create solid reserve funds so that nobody needs to do any cash calls unless it's something major. And upon a refinance, so within our thing, I like to say, if the value of this asset goes to 600, you're going to be getting a call from me to say, oh my gosh, Rav, you're really not going to believe this, but there's 3 comparables that are just like our property, because I'm an asset manager. I'm watching the whole market to figure out what our asset is doing. I think we should refinance. Are you open to that? It might be 2 years into our mortgage and you go, yeah, Mandy, I'd be very open to being able to refinance and pulling out $60,000. That goes towards your capital. We don't actually split any of this 50-50 equity till you get all your capital back. So it's a great strategy for an investor to know, if they're going to come in with me, that they're going to get their capital back before I actually get paid. So the better the deal is for my partner, the better it is for me. I think that's a really great way for people to actually know that their working partner is putting their word where their mouth is. Like, they're standing behind the properties that they're bringing to the table.
And this is not your first rodeo. I mean, how many different partners do you have now?
40 plus.
40 plus? And I'm sure there's many that just don't have one deal with you, because when you show them what you're doing, they want into the next one, the next one, the next one. So yep. Return on investment north of 20%. Yep. You don't even look at it unless your partner is getting north of 15%. I'm going to have to go on title, and I am going to put 20% down plus closing costs. I'm going to get this all back in a maximum of 5 years, because we'll refinance, maybe we'll sell, we'll figure it out, whatever the plan is. And then really quickly, I can't believe time has run out, Mandy, but quickly, what are some foreseen risk in this? When somebody says, what's the worst case scenario in a joint partnership with a deal like this in St. Catharines?
The CMHC comes through and values go down 18%, and the partnership can't hang on. Somebody needs out, right? You really only lose money in real estate when you sell, if you have to sell. So worst case scenario would be that we would, the market value would go down by 20% and we would have to be paying. So in that scenario, the joint ventureship actually pays 50-50. So I would have to upfront 50% of the loss. So this isn't like, it's not like a financial planner here where, you take a brunt of 100% of the downside and I take a portion of the upsides. This is, we're in this together, low or high. Another risk, Rav, I love having these risk top conversations, because they happen. The property goes vacant. goes vacant. Maybe there's a water storm and, our whole new windows aren't, been waterproofed properly, a contractor issue, and there's some water in the basement. We have an insurance claim. Maybe St. Catharines doesn't get the GO train station and it happens to be something that reverts. So lots of different potentials, but we don't need to jump off the edge of the cliff is what I say to people. For as much as you want to go worst case scenario, my share is we at least have to look at best case scenario as well.
Love having you on the show. Thanks so much for being here with me.
Thank you, Rav.
Thank you guys for watching. Without you, we wouldn't have a show. Remember, go to everydayinvestor.com for investment opportunities. Until then, we'll see you same place next week, same time. Honey, I love you. I'll be home soon.